folks, and welcome to this presentation on divergence. So today we're going to talk about divergence from two different perspectives. First of all, we're going to talk about the more visible, the more profound kind of divergence that you can see when you combine, for example, the asset strength histogram with a price chart. Then after that, we are going to have a look at bar by bar divergence, just so that you can see exactly how you can perform a bar by bar analysis of price together with the asset strength histogram and be able to identify areas in price where the advertised price is not showing you the underlying intention of the asset's price. Okay, so we're going to split it up in two bits. The first bit is going to be focusing on the more traditional divergence, where you have, for example, we have prices moving lower here. We have the asset strength histogram, so the underlying strength of the American dollar relative to the Swiss franc is not telling us the same story. So we can expect that price is going to follow the lead of the strength of these two currencies relative to one another. Okay, and then we're going to look at the bar by bar divergence analysis, which focuses on, which we'll do when we see price move into the beginning of the buy and the sell zones. This white line, when the histogram moves below that, we're in the buy zone, and for the white line above the zero line, when the histogram moves above, we are moving into the sell zone. Okay, so I'm going to leave it at that. I'll see you in the video. I mean, essentially, we have supply and demand software that's showing us where we have liquidity being distributed at specific rates. So we have an area of value either above or below price. And then we have the histogram, which is showing us the strength of the currencies that are competing. And when price is racing up towards a given area of, let's say, supply, I mean, this requires enormous courage to begin to sell. So if we just draw an area like so, we'll just do this in the middle like this. Okay, and then we have our market, and our market, let's assume for a second, comes from below price. So this is an area of supply. I just write that in here. So we have supply. Okay, and then price moves up towards the supply, and it's going very, very quickly. And so the question is, well, is this level of supply going to hold, or is it going to fail? And this is the golden question. And I think in a lot of supply and demand trading, normally people put their limits in to sell at this area of supply with their stops just above. Okay, and so in the anticipation that price does stop, price races up towards your entry, you get filled. And then the ideal scenario is that price goes immediately away. But this is not always the case. And this is not always the case because, I mean, when price goes up to levels like that, maybe it has to go a little bit deeper into this area of supply. Okay, so we have our pancakes just here at this area of supply. And so price goes up, but maybe the first pancake is a little bit too small. There's not enough selling pressure. There's not enough interest to sell at that level in order to cause price to leave very quickly, which is essentially what we'd like to see. So in a situation like that, price has to go a little bit deeper to the next one. And if there's nothing substantial there, price has to go deeper and deeper and deeper and deeper. And uh-oh, I mean, what do we have up here? We have our stop. And so now we have our stop being threatened. And many people will take their stop and they'll move it from here, and they'll say, oh, that's getting a little close to my stop. I think I'll move it higher, or I'll move it higher, or higher, or higher. And so down here, let's assume that we were risking 1%, or maybe here we're risking 1.25%, and then 1.5%, and then up here, let's say we're risking 2%. And so we went into the trade with an initial risk of 1%, but due to the fear of this level not holding, we ended up moving our stop to the point where now we're risking 2%. And that's a really, really bad idea. And so what we want to do in a situation like that is we want to find out if there's some kind of confirmation. And there isn't always confirmation, but there are things that we can do to help us assess if a level of supply or demand is going to hold. So I'm just going to do another example. Let's change the color to good old-fashioned red. Red, where are you? There we are. Okay, so we have our area of supply here. Get the color, and we have white. So here we have supply. Okay, we have price. Price is doing whatever it's doing, but we have an entry to sell here, and we're looking to see if we can sell the market at this price point. We do have another tool in our arsenal, and this tool was created for exactly this purpose. And so down here we have a new tool, and this tool here is our histogram. And our histogram is along the bottom of the chart like so, and we have our zero line, which looks something like this. And then we have, just to simplify things, we have our histogram, which moves from positive territory to negative territory. Since she's doing this all the time. And the beautiful thing about the histogram is what it's doing is showing us where we have the beginnings and the ends of cycles in price. And these cyclical price movements are happening on all of the time frames, on every symbol, all the time. And you have your macro cycles, which take months, sometimes years, sometimes decades to evolve, to start and to finish. And then we have our microcycles, and these start on very small time frames, from the tick chart to the 1 minute chart, 5 minute chart, 15-minute chart, and these generally take much shorter time. So in a situation like this where we have an interesting area to sell at, we have a price window here, which is an attractive price to sell this asset, and so price is moving up towards our entry, and as price gets closer, we start to get nervous. Nervous for what? Nervous over whether this area is gonna hold or not. So I just swatted a mosquito. And so this is when we can either, as some say, big stones entries, where you have your limits. So you have your limit to sell here, you put it in, you have your stop up here, then you just let it do what it's going to do. You either get filled and price moves in your favor, or you get stopped out. I mean, these are the simple, essentially the two scenarios that can occur. But what we can do is we can not put a limit order in, and we can wait. Okay, so what we do here in such a situation is we'll wait for price to reach the area. So price will go up to the area of supply, and then it'll start reacting to this area of supply. Okay, and we don't have any accurate volume readings at this area because the forex market is decentralized, and this information, this data, is difficult to obtain, unlike a centrally exchanged asset. And so price will enter this window of opportunity, and it'll start to do a dance. Okay, and this dance is typically price moves into it. Normally, actually, price will go up to the edge of it, and then we'll move away. Then price will go up, go a little bit deeper, and then we'll move away. And then it'll do it again, a little bit deeper, and then it'll move away. And normally you'll see this thing where you have price beginning to move higher, okay, which is not really what you want to see. If your entry is down here, you don't want to see price continuing to run for the highs, because this is counter to our belief that this area of supply is going to attract selling. But what we can do then is we can look down to the histogram, and we can look for the details in the histogram to show us what could be going on. And so what I like to do is I like to refer to micro supply at this area and micro currency strength data at this area. And so what I'll do is I'll mark this area off, which you can see typically by the software's rectangles, or if you like, you can draw one manually. And when you have these rectangles drawn, I mean, this enables you to go to the smaller time frame and have a look at the currency strength data at that price point. And what we want to see in the histogram at this price point is we want to see the opposite of this taking place down here. Okay, and if I just draw kind of another histogram just above this one here, so if we take out this section just here, which is essentially where price is reacting on the current time frame, and then we kind of I'll draw it just above here. And so we have, let's say this is the daily chart, and now I'm going to draw the 4-hour chart. So what I want to see in this little slice of time is I want to see price do the opposite of this. So we have price at the time price makes its first approach to the area of supply. I want to see a nice strong push up in the histogram. Okay, and then the histogram will obviously run out of steam, because when this happens, we see a lot of interest to buy. Okay, we see prices running up, and so we can expect that the histogram is going to be moving higher. What we want to see instead is we want to see the histogram reduce. Okay, we want to see the histogram begin to move towards the zero line. And this we want to see because we want to see the strength in, let's say for example that we have the euro USD. We want to see the strength of the euro begin to weaken relative to the strength of the dollar, which we want to see begin to strengthen. And you can see this when you see the histogram beginning to come down. We have the euro American dollar getting strong as it approaches this area of supply. You can see this here. Let me change the color here. You can see that here where we have the push up to the area like so. It looks like this. We have the push in the price of the asset going up like this. But now we have the asset beginning to dwindle. And on the next push higher, so we have price continuing to run for the highs. But what we want to see now is we want to see, of course, we're going to see when we have price again testing this area of supply, chasing the highs, running at the highs, we're obviously going to see an increase in strength in the euro relative to the American dollar. But we don't want the strength of the euro relative to the American dollar to be as high on the second test or the third test as we did on the first test. So let's assume that this has two runs. We have the first one here. We have the second one here. We want price to go higher, but we want, let's say this is called 1 and this is called 2. So this is the currency strength at the same area. So we have currency strength 1 and currency strength 2. So we want to see the test of the second push to be less intense as the test of the first push. And so this is going to tell us that we actually have a shift taking place where we can see the euro is losing strength relative to the American dollar in the face of increasing prices. Okay, and when you see this is an alarm going off telling us that actually we can see the flows beginning to shift between these two currencies. And because this is happening at an area of value, at an area of supply, or an area of demand if we're buying, when this is confirmation that we do indeed see this shift taking place. If you have the currency strength histogram is doing something else where we're increasing like so at an area of supply, well, this is telling us a different story. You can see that things are building up. And in a situation like this, you'll often see price go through this area of supply and find a different area of supply. Perhaps this is a child supply and price is running up for the parent. And then you're going to see this happening. If you have a good, beautifully formed area of fresh supply or demand, well then price is most often, and I'm talking 7 or 8 times out of 10, it's going to start to do this when price gets up to that area. Okay, and so in a situation like this where you have price going higher, but you have the strength of the currencies telling us something different, then this gives us confidence. In a situation like that, we want to look to sell, but we don't want to sell as soon as price enters. We want to sell when price begins to show us that it's interested in moving lower. So we can see the currency strength in the American dollar going up and the currency strength of the euro going down. You can typically see this as price begins to move away. So price will normally run higher and have a less dramatic departure it'll have another push higher, and then a more dramatic departure. And this more dramatic departure is our key. This is our sign that it's ready to sell. Okay, and so price had to eat all of these pancakes in this area of supply. We had the plate here like this and this and this, and price had to go almost all the way through the area, potentially up to the edge, to the upper edge of this child supply, before we were able to advertise the right price at which to sell. In a situation like that, when price moves up to an area, we will form areas of supply in this macro supply. So this is micro supply, this is a supply, and we will also, I mean, essentially we'll be at a draw market structure, which is going to be lower lows and lower highs. Let me reduce some of the noise here. So we're going to see prices moving higher, I mean higher lows, and then price is going to break down. Okay, at the same time price reaches this lower high on the histogram, and when this happens, you want to identify those micro areas of supply at which we can sell. Okay, and you'll see those up here, typically close to the apex of the highest push away here. Sometimes price won't go up, and we'll have something that looks like this, where price, we rally, we go sideways, we move higher, we move down, we go higher again, and then we start to break down. Then price tests, we go down, and then we test the backside of this demand, which was tested once. This area of supply consumed this demand, and this is where price will typically move away. Okay, and so this is what we want to look for. And the beauty about this is it allows us to be confident in our entries. The flip side is the price goes up to an area. If I just remove all of this noise, we make it nice and clear. And that is, if you have an area of supply that is so attractive, or demand that is so attractive that price flies up to it like a rocket, when it gets in there, we form one of those unbelievable, that was a very ugly candles, it looks like this. At the top, so price, I'm going to do it actually at the level where price goes up, and we form this candle that pokes through, and then we have a tiny little body down at the bottom, and then price departs from here, which is often the case, and then you will not get in at the proper price. Sorry, I'm going to do this properly, where we have the pin bar. Oh my goodness, we have the pin bar here, and then price leaves from here. Okay, and so the limit order would have got us in here. This confirmation will typically result in us getting in here, this kind of a price window here. So you get in at a worse price, but you have confirmation, so you increase the likelihood of the trade working out. Also, when you get in at a better price, this enables you to have a small stop, because you can put your stop above here, for example, in contrast to this, where sometimes you have to put your stop, your entry is here, and you have to put your stop maybe 2 times the size of this area of supply, which brings us above the box like this, where this one here we can sometimes have a smaller stop because we're trading micro supply within the supply that we can see here. Okay, and so there are trade-offs. You can get into a really good price if you have your limit, but on the other side, price can easily go through and stop you out. But if you're identifying these areas carefully, fresh areas where price is not traded, then the likelihood of price racing through and hitting your stop is less. Okay, well, I'm not going to go on for much longer, but try this out. Okay, mark off these areas, put alarms at the areas, so when price gets up to your preferred price, put an alarm. So put the alarm there. That'll inform you that we actually have price kind of approaching your area. And then sit on your hands and wait for this to play out on the histogram, and wait for this to play out on price, where you have the divergence occurring, and then get in at a better price. Okay. Okay, so I hope the more traditional way to perform an analysis for divergence was clear. I used a whiteboard, rather a blackboard, with no charts, and now we're going to focus on the chart, because this is the tool that we need in order to identify bar by bar divergence analysis. Okay, so what I've done with the asset strength histogram, I've built in a signal that is telling us when the the underlying strength of an asset is moving in the opposite direction to the price of the asset. Okay, and so when you see something like this where you have the asset price going higher, but you see the underlying strength of the asset not moving higher, this should make us aware of the fact that something is going on. Okay, so the first section focusing on the humps like you see, and this section is focused on these little markers that you can see here. Okay, so what we're doing is we're waiting for the completion of the histogram like so, and when you can see that we have the first push higher and then the second push higher, so we have the first one and the second one, you can see that when this one begins to run higher but the histogram is failing, what we need to look for then is we need to wait for these dots to appear. And so if you're selling, you're going to be looking for red dots that you can see just here, and if you're buying, you're going to want to start to look for green dots for buying. Okay, and you can see that here we had a low, we had a low, we had a low, and we had a low around here. Okay, price went about to the same area, to this area of demand, but the histogram started to move higher. Okay, and we got the thumbs up. Okay, we got the alert that we should be looking to buy. Let me mark that off so we can see exactly when it came. We were told that we should look to buy here on this white candle right here. Let me zoom in. So this candle right here, when this candle closed, we painted this dot, so we're being told, okay, now it's time to look to buy. Okay, and you can see that because we have a wick down and a wick up. This is price coming down and then moving up, and then price moving back down again. So we have a demand in the wick here, and so we are actually testing the area of micro demand that is down here in the bottom. You just can't see that on this time frame. Okay, so what you do is you wait for the humps to form, and after they form, then you wait for the dots to form. It's super easy, and it works on any time frame. If we have a look here, you can see that we have kind of the same thing going on once more, where we have, just going to mark off like this, where we have the highs here. See, you can see we got that dot, and we had another one, we had another push to the highs, and we started to get those dots. Okay, so let's look at when that dot was being drawn. The dot was being drawn right here. Okay, when this candle closed right here, we were told that we should look to sell. Price left, giving us confirmation. We formed an area of supply. Price tested it, and then price left. Okay, so this is essentially what we want to do. If we look at another example down here, notice that we have something similar going on, where we have price going lower, histogram going higher, but we're not operating here at an area of supply or demand. This is in the middle of nowhere. This is just at the beginning of the buy zone, and so while this could work out, and it did, it's not advisable to take because we're in the middle of the move. We're between demand and supply. So ideally, for able to get the bigger moves, it's advisable to wait until price reaches the extreme. So the top of your chart at supply, or the bottom of your chart at demand. Then the dots start to appear. This is very interesting, and this is showing us when we have hidden and traditional divergence, bullish and bearish. And what does that mean? Well, that means that, let's see if we can see which one is which. So this one here, okay, this candle here is higher than this candle, but this histogram bar is lower than the previous. Okay, so that's telling us that there's a disconnect between the advertised price and the underlying strength. The underlying strength is getting weaker. The advertised price is going higher. So this is actually liquidity exploration, micro exploration, because it's not very visible on this price chart. But then we're seeing this again several times. We got another one here where we had price move higher, the histogram moving lower, and then we got the same one here where we had prices going higher from this bar to this bar, the histogram going lower, and we have another one here, and this is also traditional divergence where you have higher highs in price and lower lows in asset strength. What happens? Well, price departs, we form the supply, and then price leaves. Okay, well, I'm going to keep this video super short and sweet, but if you have any questions about any of these, then please let me know. Happy trading, and thanks for watching.